What's up, investors? Today we're diving deep into one of the most popular dividend ETFs on the market, SCHD, the Schwab US Dividend Equity ETF. If you're looking for steady income and defensive growth, this fund has been a favorite among dividend investors for over a decade. But is it right for your portfolio? We'll cover everything: the pros, the cons, current yields, and why it might be lagging behind the broader market. Let's get started. SCHD tracks the Dow Jones US Dividend 100 Index, which focuses on high-quality dividend-paying stocks. This isn't just any dividend fund. It specifically targets companies with strong fundamentals and consistent dividend histories. The fund launched in 2011 and has grown to become one of the largest dividend-focused ETFs with billions in assets under management. It holds 100 stocks, all carefully selected based on dividend sustainability, not just yield chasing. What makes SCHD special is its screening process. It looks for companies with at least 10 years of consecutive dividend payments, strong financial health, and reasonable payout ratios. This quality-first approach has been key to its success. Let's talk about what makes SCHD shine. First, that expense ratio. At just 0.06%, it's incredibly low cost. Compare that to the S&P 500 ETF SPY at 0.09%, and you're getting strong dividend exposure for less than one of the largest S&P 500 funds. The current dividend yield sits at approximately 3.75%, which is substantially higher than the S&P 500's typical 1.5 to 2% yield. But here's the real kicker. SCHD has grown its dividend by an average of 10% annually over the past decade. That's dividend growth that actually beats inflation and provides real income growth. This defensive nature really shows during market downturns. When growth stocks get hammered, SCHD's focus on established, profitable companies with strong balance sheets provides stability. These aren't speculative plays. They're companies with real earnings, real cash flows, and real commitment to returning money to shareholders. The fund also provides excellent diversification across sectors, though with a tilt toward value-oriented industries. You'll find healthcare giants, consumer staples, industrials, and financials, all sectors known for a reliable cash generation. Now, let's be honest about the downsides. The biggest issue with SCHD is its limited technology exposure. While the S&P 500 has been driven higher by tech megacaps like Apple, Microsoft, and Nvidia, SCHD has minimal exposure to these high-growth sectors and themes like AI. This sector bias has led to underperformance against the S&P 500. However, the limited exposure to AI and tech means that SCHD's portfolio trades at a much more modest price into earnings. It's the classic trade-off between growth and income. You get steady dividends, but you might miss out on capital appreciation. On the flip side, drawdowns in the tech sector won't weigh on SCHD as much as it would for the S&P 500. The fund may also be seen as less diversified than total market ETFs. With only 100 holdings focused on dividend-paying companies, you're missing entire segments of the market. I'll make another video about diversification. However, I believe there is more concentration risk in the S&P 500 than SCHD due to market cap weightings. Another consideration is dividend tax treatment. If you're in a taxable account, those quarterly dividends are taxed as qualified dividends, which could be taxed differently depending on how much you earn in dividends. Let's talk numbers. Over the past 10 years, SCHD has delivered solid returns, but it has indeed underperformed the S&P 500 during bull markets. This is primarily due to its value tilt and limited tech exposure. However, the story changes when you factor in dividends and look at risk-adjusted returns. SCHD tends to hold up better during market sell-offs, providing that defensive quality many investors value. The fund has shown lower volatility than the broader market, which appeals to income-focused investors. The 10% annual dividend growth rate is particularly impressive. This isn't just about current income, it's about growing income over time. For retirees or those approaching retirement, this growing income stream can be incredibly valuable for maintaining purchasing power. Recent performance has been challenged by the market's preference for growth over value, but SCHD's fundamentals remain strong. The companies in the fund continue to generate cash and increase their dividends. SCHD makes sense for several types of investors. If you're nearing or in retirement and want steady, growing income, this fund offers compelling value. The defensive nature and consistent dividend growth provide stability that many retirees need. It's also excellent for investors who want to tilt their portfolio toward value and income without picking individual stocks. The professional management and screening process takes the guesswork out of dividend stock selection. However, if you're young with a long time horizon, you might want to consider whether you need this much income focus versus pure growth. The opportunity cost of limited tech exposure could be significant over decades. SCHD works well as a core holding in a diversified portfolio or as a complement to growth-focused investments. Many investors use it as their boring stable allocation while taking more risk elsewhere. So, is SCHD worth it? For dividend-focused investors, absolutely. The combination of low costs, quality holdings, defensive characteristics, and 10% annual dividend growth makes it a standout option. Yes, it has underperformed the S&P 500 recently due to limited tech exposure, but that's not necessarily a permanent condition. Market cycles change, and having defensive dividend-paying stocks provides valuable portfolio diversification. The 3.75% current yield and 0.06% expense ratio represent excellent value. If you're building a dividend portfolio or want defensive exposure, SCHD deserves serious consideration. Just remember, no single ETF is perfect for everyone. Consider your goals, time horizon, and risk tolerance. SCHD excels at what it's designed to do: provide high-quality dividend exposure with low cost and defensive characteristics. That's a wrap on SCHD. Let me know in the comments if you own this fund or if you're considering adding it to your portfolio. If you want to watch me grow a portfolio of just SCHD, follow my channel for updates.